Welcome back. Between rising inflation and the barrage of looming Fed rate hikes, our next guest says that investor pushback has shifted from inflation peaking to when will it end and where will it land. Joining us now is Stuart Kaiser, UBS head of equity derivatives research. Stuart, always great to get some time with you here. Look, really bad close on Friday for the markets. I mean, how much downside risk do you think there is left for the NASDAQ and S&P 500 here?
Hey, good morning, Brian. Yeah, it was obviously a pretty painful week to end the month last week. I mean, look, in our opinion, the risk reward is actually going to start to improve over the next couple of months. I think what the markets are struggling with right now is something you touched on before, which is, conversation with the Fed has been a little bit unstable. And because there's a lot of hawkishness priced into the market, folks are starting to kind of worry about recession risks as you get into next year, on the fear that the Fed might have to over-tighten. In our view, inflation has peaked, and as you see inflation decline during the summer, it should actually materially improve how people are thinking about the world. But I think where we are right now, ahead of the FOMC, very hawkish Fed, shutdowns in China, et cetera, folks are just really kind of starting to price downside risk to the growth outlook, and that's what's put pressure on markets.
And so what do you think the next phase then is, especially if you look at the Fed this week and then the jobs report as a catalyst, Stuart?
Look, from our perspective, you kind of have a three-step process here. The first is inflation needs to peak, and our economists think that's happened. The second, I think, is over the course of the next month or two, you need to get more data to confirm that. And hopefully once that data comes in, that'll allow the Fed to kind of dial back the hawkish rhetoric at least a little bit. And I think once that happens, the market will say, well, now we're in a situation where the Fed might not over-tighten. That improves my growth outlook, and that kind of allows things to improve. So I think there is kind of a three-step process. I think we're very early in that process, but hopefully, based on how we view inflation over the next kind of 6 months or so, that's how it's going to go. In terms of the jobs report, we do have about 300K out of our big data nowcasting team. So, it's still a very, very solid number. We do have retail sales decelerating a little bit. And I think you combine those two together, people will be just a little bit concerned that, higher oil costs and higher input cost inflation is maybe starting to hit spending power a little bit. But, the fact is we're decelerating relative to last year off a very, very high growth rate. So the numbers are going to look a little softer. But, in our view, these are not recessionary numbers. This is just kind of a slowdown from what was a very, very strong growth rate last year.
Do you think the Fed should just hike rates 75 basis points this week and get it done with?
Our house view is that they do 50 and that they begin the quantitative tightening process by rolling off the balance sheet. And that should actually be probably the most hawkish meeting we get during this hiking cycle, because that quantitative tightening actually is pretty similar to about a 25 basis point hike. In terms of what they should do, I think it seems like, as you said, there's a lot of disagreement or wide range of opinions, across the FOMC. I'm sure they're going to look at what's being priced into the market. And I think they probably don't want to be, a net surprise relative to market pricing. So, our view is they go 50 this meeting and they go 50 the next meeting, and then inflation comes down and they're able to kind of dial it back a little bit. But, I think broadly speaking, to your point earlier, it's clarity of communication and it's clarity of message that is probably the most valuable thing they can do in this meeting.
Stuart, I don't know if you heard a few moments ago, we were talking about just the dismal month that the NASDAQ had and large cap tech stocks had. In your note to us, you talked about the risk reward of tactical hedges in some of the mega cap tech stocks. What does that mean for the layperson when you're looking at those kinds of trades?
Yeah, look, I think, you guys made a great point in terms of how a lot of, we look at the NASDAQ index and it's down a lot, but, below the surface, this is being driven by single stocks. And I think there's probably two things that have been causing that. One is this concept of pull forward of demand during COVID, and, how much demand was pulled forward from previous years and is going to have to sort of be give back. And I think like a Netflix will kind of fall into that category. And then the second is input cost inflation. And it seems like from Amazon's comments, they're kind of facing that a little bit. So I think you had basically, would have been a monster performance for a couple of years in large cap tech. And now folks are, I think, less focused on what was the earnings print and a little bit more focused on what the forward guidance was going to be, related to input cost inflation as well as pull forward of demand. So, our view was, taking some risk off the table, maybe protecting some of those gains a little bit going into earnings season, just made a lot of sense because the performance had been so strong, but you had these kind of building challenges And just really a lot of uncertainty on how companies were to comment on that. A number of tech companies stopped providing guidance this quarter because there were so many moving parts. So our view was they performed well. Maybe a good time to protect a little of those profits ahead of earnings season, given the challenging outlook.
Out of all the trades you watch, Stuart, closely, are you seeing strong positioning for the S&P 500 to fall below 4,000?
Brett, we've seen a lot of hedging flows in S&P as well as other indexes like small cap Russell 2000. So, a lot of hedging. Whether the view is it gets below 4,000, I think it probably is dependent client by client. The other places we've seen a lot of protection and hedging being put on is in U.S. retail. So that would be XRT as an ETF and in home builders. So I think both home builders and retailers have been areas where clients have been getting growing concerns. I think on the retail side, it's because of input cost inflation, and on the home builder side, it's because rates have been rising. So yes, we have been seeing folks, hedge S&P 500 and the broader based indexes, but we've also seen them kind of targeting parts of the market most impacted by consumer spending and interest rates as well.
Stuart, good to see you. Thanks so much and have a great week. UBS Head of Equity Derivatives Research, Stuart Kaiser.